Hi, I'm James Robinson, and this is my stock pick of the week. This is my fifth video on the company, Graham Holding Company, symbol GHC. Today we're going to talk about wealth creation, which I think is the most important, or one of the most important aspects of a company. To me, wealth creation is what kind of job does the management do in making a more and more valuable company for the shareholders to own, and to what extent are they able to return wealth to the shareholders? I believe that a company can return wealth to the shareholders in a number of ways. So we're going to look at all of those and see how Graham Holdings stacks up to other companies that I've looked at. One of the ways that a company can create wealth for shareholders is through share repurchases. So what happens with a share repurchase is a company takes some of their cash and they buy shares on the open market. By doing that, they reduce the total number of shares that are in the marketplace, and therefore proportionately the people who are left owning shares own a larger percentage of the company. So using round numbers, if there used to be 1 million shares outstanding, the company bought 100,000 shares, there'd be 900,000 shares left, and those shares would be worth 10% more of the company than they were when the company started. It's a tax advantage way of creating wealth for the shareholders because the shareholders had their earnings and their percentage of the company increase. They didn't write any checks to do it, they didn't pay any money to do it, and the government doesn't get to tax them for that. So it's one of the tools that management really likes to use. It's also a self-serving tool that management uses because when the company buys back 10% of the shares, let's say that company made $10 million. Well, that $10 million of earnings on a per share basis has increased by 10% because there's 10% less shares to spread that money over. And so companies that are able to buy back shares are able to make their earnings per share increase year after year after year, even if their earnings are flat. And that's one of the tools that management will use to make themselves look good. And so the reason you see share buybacks so prevalent is because it's both good for the management and good for the shareholders. Now, where it breaks down is if you're buying shares that are too expensive and you're paying $1.20 for $1 worth of stock. We're going to ignore sort of that when we look at these stocks today, because that means that we have to figure out what the stock is really worth. Basically, if I'm buying a company, it means that I believe the company's current market value is below. The current market value is above the share price, right? So I think we're buying a company with a margin of safety. So if a company's buying back shares right now, I think it makes us look pretty good because I'm willing to buy back the shares, and therefore the company should be. So let's look at Graham Holdings. If you look at Graham Holdings, you can see the company had about 9 million shares, almost 10 million shares 5 years ago, or 10 years ago. Today they have just over 6 million shares. So they bought back about 75% of their shares in the last 10 years. That's fantastic. And you can see that while in 2017, the number of shares went the other way, they actually sold shares to the market. I believe that that was the result of an acquisition. They bought a company and they used shares to do it. Every other year, the company is kind of when they see that the stock price is lower than it should be, this company comes in a big way and buys shares. I believe that in the last 12 months, this company has bought back about 7% of the shares of the company above and beyond what's reflected here, and they did that during COVID. And that's, again, an example that management really isn't just buying shares for the sake of buying shares. They're not buying shares for the sake of goosing their earnings per share. I think what they're really doing is they have an idea of what they think the intrinsic value of this company is. And when they see the company is below that price, they buy back shares and they do it in a big way. It's one of the things that really led me to buy this stock is this idea that the company's enriching me in a tax-free way. So I showed you the chart that shows you all the share buybacks and how it works, but sometimes it makes more sense to look at these things just in a purely quantitative way. So if you'd owned 10% of Graham Holdings in 2009, you would have bought about 933,000 shares. There's about 9.3 million shares outstanding, 10% is 933,000 shares. Today, as a result of stock repurchases, your 933,000 shares, which you mean your ownership in the company has increased from 10% to 17.65%, right? So that's about it's about 76% increase. So your share of the company has increased by 75% over 10 years, and you haven't had to spend a penny to do it. So that's fantastic, right? That's really, really buying back shares at a fantastic rate. Even better, while that was happening, the earnings were increasing. So your share of the business, when you bought the thing in 10 years ago, your share of the business would have generated you about $9.9 million worth of profit. Now, that's not dividends. That's just your share of the profits that the company was able to generate. Fast forward the tape till now, and that company would generate $57 million in earnings last year. So that's fantastic, right? So the earnings have gone up very, very quickly over 10 years. And Looked at another way, you would have gone from earning $9.94 per share 10 years ago, and today you'd be earning $62 per share. So these stock repurchases, you can see how they really quickly add up to the benefit of the shareholder. It's one of the things that I really like about this company. And these two slides are a very, very significant reason for why I bought this company. I just think over the long term, they're going to take care of us as shareholders. I like the management of this company, and I'm willing to overlook that. Yes, Kaplan, which is the education department subsidiary, had a horrible year last year because of COVID. In the long run, when management makes smart decisions and puts the shareholder first, it generally works out well for the shareholder. And so I give these guys, and you're going to see later, there's a couple of slides that are suspect. I give these guys the benefit of the doubt that they're going to figure it out. And these are sort of the reasons why. Another tool that I use to figure out the job management doing is shareholder equity. So shareholder equity in conjunction with dividends paid out tells me a lot about what's happening to the money that this company makes. So if you look at it between 2001 and 2008, this company's shareholders' equity has gone from about, call it $1.5 billion to about $3.5 billion. Since then, that money the equity has been very, very flat. Although, to be fair, since 2017, the shareholders' equity has gone up from about $2.5 billion to about $3.5 billion. So again, in the last 4 years, that shareholder equity is starting to tick up very nicely, but it's been very, very flat for a long period of time. So this is shareholder equity. Now, what that tells me is they're not needing to hoard a lot of cash. Shareholder equity is the total amount of assets the company has minus the total amount of debts, right? And as that money is going up, as that equity is going up, then you say, okay, they need a certain amount of cash to make money. I've shown you that the earnings over the last 10 years have gone from, $9 million to $60 million. And yet the amount of equity they've needed to do that has remained constant. Now, some of that has been because of debt, but a lot of it's just been the company's very, very efficient. So I like this because, again, if the company was hoarding tremendous amounts of cash, the shareholder equity would be increasing dramatically and maybe faster than the earnings. And that's a problem. That means the company needs too much money to make money. This is the opposite. And so I like this. And even the next slide is even better. The next slide is shareholders' equity per share. And this is really fascinating because even though the equity has been very, very flat, as we've talked about, the company has bought back, a significant amount of shares. And the result is that the shareholder equity per share has gone from $175 a share to almost $600 per share. So this company is trading very, very close to book value. And again, in the last few years, it's gone up dramatically. So the shareholders' equity tells me that because the equity per share has been very, very strong and gone up sort of every year up and to the right, the total amount of equity they need to make money has been very, very flat. Those are two really, really good scenarios that we like as investors. I look at another important thing that I look at, we talked about how much money does the company need to make money. Another way of looking at it is how much money does the company make off of the money that they have tied up, right? There's nothing exciting about a company if you have to invest $10 billion in the company so it can make you $1 of profit. That's not exciting as an investor. What's really exciting as an investor is if you could invest, $100 in a company, it made you $100 a year in profit. That'd be 100% cash on cash return. That's probably unreasonable to expect in the long run. But what we're looking for is companies that don't need a lot of money and are able to generate returns on that money consistently. So when you look at this company, you can see, so this looks at return on assets. So it's not return on equity, it's return on assets. The total amount of wealth that this company has tied up in its business and what kind of return is it able to get. And you can see that for the last 3 or 4 years, it's earned about 7.5%. That puts it in the top 25% of companies in terms of return on assets. I don't need a company to be in the top 10% to be interesting. What I want to know is that this company is reasonably efficient at returning assets into profits. And if they're reasonably efficient at turning assets into profits, and then on top of that, they have a shareholder-minded mindset where they want to figure out how to use the money that they make to further enrich the shareholders, that's a great scenario. And so that's what we're seeing with this company. The return on assets is in the top 25% of companies. It's very, very stable. This company doesn't seem to take a lot of risks. Year in and year out, they do well. Again, there's this blip there in 2014 and 15. There's going to be good years and bad years. You have to accept that. But in the aggregate, pretty solid company. This next slide uses the exact same concept, but instead of looking at return on assets, which is the total amount of assets the company has, we're looking at return on shareholder equity. The difference is shareholder equity is the total amount of assets they're using minus the total amount of debt. Generally speaking, again, this looks at how this company compares to the average company that I've analyzed, the 1,000 companies that I've analyzed. Generally speaking, my companies will almost always underperform the market in terms of return on shareholders' equity. And that's because my companies don't tend to be very levered. A lot of companies have a tremendous amount of leverage. They're able to make profits and they have very little equity. So those profits relative to equity look fantastic. My companies don't typically do that because I think too much debt is too much risk. So but again, what you can see is the return on equity of this company is pretty stable. It's around 12%, 12.5%. In a 3% interest rate environment, if you can make 12% on equity, you're doing great. The shareholders are getting rich relative to inflation, and that's wonderful. So again, return on shareholder equity isn't spectacular for my companies. It very seldom is, but it's solid, and it's a reason to continue to be interested in the company. Retained earnings. I don't think a lot of people pay attention to retained earnings. I don't think a lot of people understand why it is or isn't important. I think they sort of look at it as a byproduct from their operations. And for me, I feel very differently. I feel it's a very telling way to understand what kind of job management does in terms of being shareholder minded. So let me sort of explain what happens. When a company turns a profit, at the end of the year, there's this pile of cash. The company can do anything it wants with that money. It can reinvest it in other companies. It can reinvest it in their own business, their current operations. They can pay down debt. They can pay dividends. They can buy back shares, okay? Now, if they use that money and they retain it to put back in the business, that's fine, but that's money that can't then be paid to me, the shareholder. And so if they're going to hold my money and not give it back to me, in my opinion, they have to have a good idea of what they're going to do with that money that's going to make me richer, because they're holding my money and they have to use it to make me richer. Now, some amount of retained earnings is required by every business simply because of entropy, right? Businesses, it takes money to make money. You know, equipment breaks down, you have to replace it. Factories get outdated, you have to build new ones. Whatever it might be, every company has some amount of retained earnings that's required to sustain their operations. I like companies that require very little, because that amount of retained earnings is not going to increase the value of the business, it's going to maintain the value of the business. So the higher that number is that's required to maintain the business, the less sexy that business will be to me. So what you can see here is that we know what the earnings have done in the last 20 years for this company. We know that in the last 10 years they've gone up dramatically, but look at the retained earnings. They've hardly gone up at all. Every year they use just a little bit of money for retained earnings. What that tells me is they don't need to be reinvesting significant amounts of money in their business to make the business grow. That's fantastic. As a shareholder, I like that, because that means there's more money to either A, give back to me, which I like, more money, and they do that through dividends, and they do that through repurchasing shares, or there's more money to invest in the business, hopefully in ways which will grow the income stream to the shareholders. So that's what's happening with retained earnings. That's why I think retained earnings are important, and you should look at them. So I talked about the importance of retained earnings, but how do we figure out if the company is efficiently using their retained earnings? That's a really hard thing to quantify. I've got an oversimplified way of doing it. It's not accurate, or not tremendously accurate, but it just gives you a sense for what's going on. What I do is I take the total amount of earnings the company's retained over a 10-year period of time, and I look at the total increase in earnings that the company's generated over a 10-year period of time. And sort of my theory is that those earnings are the direct result of the retained earnings. Now, they may not be, but for the standpoint of what I'm looking at, they may as well be, right? Because I don't have any other way to measure how efficiently they're using retained earnings. And so again, when you look at this chart, it's a little hard to understand what's going on. But what I've done is I've said, here's how much money the company retained over a 10-year period of time. Here's what happened to the earnings over that 10-year period of time. And what kind of return did we get for the earnings that we retained? And you can see this is gyrated pretty dramatically. Part of the reason it gyrated is because, again, this company sold the Washington Post and has been reallocating their assets away from this newspaper and into other businesses. They've bought some businesses. Oftentimes when you buy businesses, you have to invest money that's kind of deferred maintenance into the business. I'm okay with that. What you can see is the last couple of years, it's been about my goal is that a company gets a 10% return on retained earnings. And this company, you can see, for the last couple of years has been north of that. They haven't been north of that for a long period of time. But again, I give this company a lot of leeway because I understand a little bit of what happened when they sold the Washington Post. And I see the companies they've been buying since then. And I think those companies are going to, when we get past the pandemic, are going to be very solid earners for us. We'll see if I'm right. That's the gamble. But that's what I'm seeing with the company. Something else that a company can do with their money is retain the earnings in cash or cash equivalents, marketable securities, which is something this company has done a lot of. This company has about $650 million in marketable securities. I know that the management of this company is very much Warren Buffett-esque. They're value investor kind of guys. I can't see exactly what they own, unfortunately, but what we can do is just have a sense of things that they bought otherwise and look at the profits and the capital gains that they've made off of those companies. And it seems like their portfolio is probably pretty strong. So I don't mind if they retain money in cash. I also think cash is a way of enriching the shareholders. If you have cash, you have the opportunity to take advantage of things when they happen. As for example, this company bought back a bunch of shares, 7% of the company in the last 12 months as a result of COVID. That's something you can do if you have cash that you can't do if you don't have cash. So I look at that as one of the strong things a company can do is increase their cash position. And I look at it sort of, you can reduce your debt or you can increase your cash or you can give the cash back to me. If you give the cash back to me, you can no longer use it for opportunities when you see them. Also, if you give them back to me as dividends, I've got to pay income tax on it, so I don't get as much. And so if a company demonstrates that they're intelligent and efficient at using cash, I don't mind if they increase the cash position. This company is a conglomerate. They're buying companies. They're buying a company right now. And so as long as I believe that the conglomerate, that the companies they're buying are solid performers, I'm okay with this. In fact, I'm actually pretty happy with it. This is the slide that's very disappointing for me about this company. It's also why I think we're able to buy the company at 7 times earnings. I also think it's partially artificial. So what we look at here is again, we've talked about this a lot. The company has lots and lots of things they can do with cash. They can use that money to pay down debt. This company has increased their debt load. They can use that money to pay dividends. They pay dividends, but 1%, really, who cares? It's not very much. They can buy back stock. They've done a lot of buying back stock over the years. And they can use the money to increase the cash that the company has, which increases their reserves. They can also reinvest the money back in the business. I've already talked about the portion that they take and reinvest in the business. They seem to be getting about a 12% return on that. Fantastic. But with the rest of the money, you can see here that the last couple of years have been rough. And this company over so the orange line represents the cumulative of all of those lines over a 5-year period of time. And for a very long time, until about 2017 or 18, this company did a great job of creating total wealth for the shareholders. In the last couple of years, they haven't done as well. I'm going to need to see that line change pretty dramatically. It's probably not going to change in 2021 because COVID is going to take some time to recover from. But I would expect in 2022, we're going to start to see that all of these lines are going to be significantly improved. And if we don't, I'm going to frankly probably be very wrong on my bet for this company. So that does it for wealth creation for Graham Holdings. Again, the fundamentals are there. They're buying back stock. They've got cash they seem to be using efficiently. Their retained earnings are getting a good return. They're getting good return on assets, okay returns on equity. I'm not as happy with this slide, but generally speaking, the wealth creation for this company, especially over the long run, has been very, very good. So this slide, I always talk about how I'm doing, how my portfolio is doing. This portfolio is what you would currently have in your portfolio if you had invested with me exactly as I suggested that you invest, either through these videos or through my Twitter tweets. Because every time I buy or sell a stock, I tweet about it. My Twitter handle, by the way, is @RobinsonStocks. And if you want to follow that. But these are, if you'd bought when I told you to buy, at the price I told you to buy, and you'd sold when I told you to sell, which I've only sold one stock this year, this is how you'd be doing. So we're up 21.9% for the year. That's fantastic. That includes dividends. Of all of the stocks that I bought, and there's probably 20 something, 22 maybe, I have 2 stocks that are down. Everything else is up. I've got stocks that are up very, very significantly, 50, 60%. Most of my stocks are up north of 10 or 12%. guys, we're in a bear market. The market is running crazy. Some of this is me being, doing okay with my stock picking. Some of this is a rising tide lifts all boats. I haven't sold any stocks. You see the different colors here. The stocks that are in bright green, for example, is Intel. That's a stock that I sold. Every other stock I've held, some of these for over a year and a half. The ones that are in green are permanent or semi-permanent positions that I bought very cheap. I really, really like the companies. I'm likely to hold them for the long term. I'm having a couple of second thoughts about a couple of these, which I might talk about in a future video. And the reason I'm having second thoughts about holding them forever is these stocks have gone up dramatically, and I think they're perhaps significantly above their intrinsic value. And I might sell them because I have no more cash, and I've got new stocks that I'd like to buy, and I like more than some of these now. So you may see me selling some stocks in the next, couple of months. But for now, this is my portfolio. The light blue are companies that I consider speculative in that I like the company because they were very, very cheap. They're not spectacular, hold for the rest of your life kind of companies, all of them. They're companies that I bought because I like the intrinsic value relative to the price, and I may or may not sell them, at any moment. So that's basically what's happening to the portfolio. We're doing great. We're outperforming the S&P 500. I haven't looked at it recently, but I think we're outperforming it by 10 or 12%, which is great. I'm very excited about that. It kind of shows all the hard work is paying off. So that's it for Graham Holdings Company. I appreciate you watching. Thank you very much for your time.